Hi everyone, it's Daniela Coulier here from Shareplicity, and I'm really happy today because I'm going to be chatting with Michael Frazis from Frazis Capital Partners. And Michael is quite well known. He appears on AusBiz, he has his own podcasts, videos, and he's one of these fantastic new young investors who basically, I think, is involved in democratizing information and research about growth and technology and life science companies for investors through social media platforms. So welcome, Michael, and thank you for having a chat.
Thanks, Danielle. It was quite an introduction. Thanks for having me on.
My pleasure. So what I thought we could start with, I was doing a little bit of research about how you analyze companies, and I'm really interested to explore the whole concept of what you term customer love. And I was hoping that you could expand a little bit in terms of when you're looking at customer love, how much of that is a quantitative versus a qualitative analysis for the companies that you look at?
Sure. I guess the whole idea kind of comes about when you look back over the last 10, 15, 20 years and trying to figure out what were the best performing companies. They're all companies that had this crazy, customer obsession. They're extremely controversial in the investment world, generally heavily shorted. The customers love them. This is companies like Netflix, Tesla, in Australia, Afterpay, Amazon, Google. These companies weren't just good performers. They're the key drivers of returns and outperformed, all kinds of value stocks and all kinds of strategies. So the idea was like, how can you actually identify these things early? What did they look like at the beginning? Or not even in the beginning, 10, 15 years into a 20-year journey.
Yeah.
And the reality is they all had that one thing in common, that extremely devoted customers. And I'd say the key differentiator, or what we're trying to differentiate between, is things that have an amazing brand and things that have customer love. Like, that's a big question. So a lot of professional investors focus on brands and brand value. And rightly so, brands do have value. But we're talking about something different. We're talking about companies that go above and beyond that point. So an example in the audio industry, there's probably 20 amazing car brands. Toyota's amazing car brand, Fiat, Honda, Holden, Jeep. I'm trying to remember car brands.
BMW.
The problem is brands like that in a highly competitive industry, they have to compete on price and features.
Yeah.
And that's the key point. It's like, are you competing on price and features? Or do you have something special that allows you to charge a little bit more and capture profit margin that isn't available to others and generate sales that isn't available to others? And that's a happy situation a very small number of car companies in, including companies like Tesla and Ferrari. They've really got that customer obsession. And the other thing we obviously look for is explosive growth, which is why we wouldn't own Ferrari, but we do own Tesla. But right from the beginning there, that customer love manifested in two ways. The first was in a price premium. They're very expensive cars and people were willing to pay. But the second thing was in sales and growth and just execution. So Elon Musk could get up and pre-sell hundreds of thousands of cars, with a presentation and a few photos while saying that the final details were yet to be revealed. There is no other car company that can do that. And that's what we mean by customer love. It's that ability to charge an extra price and have this devoted fan base so that you can generate sales, and develop amazing fundamentals. Yeah. And there's examples of like that again and again and again in different industries. And having seen it so many times and just watch these companies deliver again and again and again, it's really what we look for. We really want to start with the customer and find that customer love.
Yeah, it's so true. It's Tesla's one of those things that the first two chapters of both of my books that I've written have been based around the Ford versus Ferrari film, because I think that whole concept of how you actually create a car like a Ferrari where they're hand built and people will, just obsess about these cars. They will dream about owning one, no matter, my ex-husband had a Dino Ferrari and we used to get in it and it was noisy, it was hot, and the fumes used to come back on top of the passengers. And yet it was one of those cars that everybody loved and everybody wanted, even though I always felt very self-conscious in. And Tesla's a bit the same. It's like people go, well, why on earth is this company doing so well? And you literally just have to say to them, have you sat in a Tesla? Have you been for a ride in a Tesla? And a friend of mine rocked up in her Tesla. And it's one of those experiences that you just go, oh my God, this is so cool. This is so different. And you know, it's not only women. I mean, well, I should say it's not only men, it's actually women. If you like a car, you kind of go, this is incredible. And so I get where you're coming from completely, because I can see the obsession in something like that. And it's really interesting because my son recently, he went and bought a Huawei computer, and he was like, Mom, I'm getting Huawei. They're so much better, yada, yada, yada. And then he said to me the other day, no, I'm going back to Apple. And I guess that's probably, it's not a company that you would necessarily own, because Apple might be probably 2x growth or too mature, but it still has that incredible following. I don't know what you think in terms of people that just keep on going back to Apple products.
Yeah, definitely. Absolutely. I mean, that's another archetypal example. So I owned Apple from about 2010. Now in the fund, we've just had to say, look, we're not going to own any of those big tech. You know, if you want to own that, do it yourself. Highly encourage.
Yeah.
And the Nasdaq 100 is just an amazing index. It's got all these amazing tech companies. We need to do different things. We need companies that are growing much faster, much higher return opportunities. But Apple definitely had that, and always had that the whole way through. Certainly in the second Steve Jobs era. So you think about competition, that point about price. Companies that compete on price and features. So Huawei, Sony, Samsung, LG, you know, there's a whole raft of competitors. Back in the day, Microsoft Microsoft. What was the other one? Nokia. Like these are amazing brands. They're amazing companies, incredible technologists at those companies, incredible engineering, manufacturing, like real kind of know-how, a huge amounts of value. But the reality is when it comes to that key point, which is when consumers decide to spend money on this product or that product, or click this button or not that button, or this payment option on that key decision point, Apple always won that. And they won that. You could see that, you know, you asked if it's qualitative or quantitative. One qualitative thing you could see 10 years ago was that people would queue outside shops to get an iPhone. They'd pitch tents up. And people be like, this is absolutely ridiculous. What kind of like consumer culture we created? There's a temple of Apple and people are worshiping and, you know, literally like taking it in turns to sleep on the street. Just to get their hands on one of the first of 100,000 phones that was sold that day. That's customer love. That's devotion. And what happened? You know, Apple charged a few $100s extra. And there were years where Apple captured the profit margin of the entire industry. And so it's an interesting point because it's an interesting observation, because often there are times where you see these analyses where people compare one amazing company with customer love to a company, to the rest of the industry. But that's actually completely rational. You know, when people say Tesla's worth more than the rest of the auto industry, I'm not sure like to the extent to which that's valid. But in theory, if a company like Apple or Tesla is able to offer a significant premium and catch a significant margin, and everybody else is basically breaking even after CapEx and all those hidden costs, then it is actually rational for that company to be worth materially more than all the others combined. And Apple is an example where there were many years where Apple had the entire profit margin of the industry.
That's
the rest of the
amazing,
industry
isn't it?
broke even or lost money, and Apple captured it.
And
so, you know, the idea of customer love is pretty abstract and it sounds kind of funny, but, you know, it really explains this behavior, allows you to predict which company is going to do best, and ultimately translates into fundamentals.
Absolutely. And you see it, as you say, in the revenue growth, the sales growth, and then the margins. And although I don't want to spend a lot of time on Tesla, I think that's probably going to be one of those companies which is really going to prove, with their pursuit in the excellence of manufacturing, to become the best manufacturer in the world. And there's been some work done by a guy called Pierre Ferragu, who's done some work on the actual margins on the company and how high they are. And as you say, as the premium for the product and the customer love feeds through, that will be exhibited over time in terms of not only the actual revenue growth that they can achieve, but as you say, the margins that they pick up from the others who are all scrambling to follow on in the wake, so to speak. But maybe moving on from customer love, do you want to have a little chat about, because I know you're very passionate about the life sciences, and just to expand a little bit on what's your definition of life science companies and how do you look at them? And then as a percentage of your total portfolio, Michael, because I'd like to also tease out a little bit, because you're obviously in high growth stocks, which tend to be a little bit more risky or more volatile at the very least. So first of all, if we touch on life sciences, then what percentage of the portfolio do they represent? And then we can work maybe down a little bit further down the track, how you asset allocate across different companies.
Yeah, sure. So by life sciences, we really mean anything to do with healthcare. Now, we kind of like the same way we won't invest in Google. We don't invest in those big pharmaceutical companies or hospitals. It's not really our game, not really interesting or exciting. I think we say life sciences because it's a broad term that encompasses, software companies that are working in the space, or people developing or digital health or things like that. And it kind of draws a distinction between biotech. And the reason for that is that biotech has a pretty bad name. There's been several, biotech booms and busts. It seems Australians in particular love a specky biotech.
Yeah, they do, don't they?
Yeah. Well,
Not mentioning any names like Mesoblast.
Yeah. Well, there's a handful of companies that have done really well, like CSL and ResMed. They made a ton of money for the sector and for early investors. And that it seems like there's kind of a speculative spirit in this country, whether it's commodities or biotech. Yeah. If you talk about biotech, people think, okay, that time that my uncle told me to buy a company with one drug and then it failed and I lost all my money. And everyone's always talking about, if it succeeds, you'll make 10 times your money. If it doesn't, you'll just lose your money. It's a 10 to 1. It's got a chance of succeeding. You should that's nonsense. Whenever you hear people talking like that, they're going to lose their money on something.
Yeah.
You really need, I think, in the life sciences to be convinced, deeply convinced that the technology works, that the science works, that it's robust, that it's been done in a proper way. And then in those situations, they can be some of the highest returning companies in the world, as well as, the most valuable to society at large. I mean, it's pretty hard if you compare about what most of our companies are doing, they're just competing in a market and winning consumer dollars. Whereas the life sciences ones are curing horrible diseases, generating vaccines, really moving things forward. And that's kind of exciting. So we've probably spent a disproportionate amount of certainly my time on it. It's about 35% of the portfolio. It's a bit over a third.
Right.
But we think it's pretty differentiating. It's really helped us. As you say, we're in very volatile names. Like our organic growth rate used to be about 100% on average across the portfolio. In the last quarter, it actually accelerated to almost 150%.
Wow.
So that's immense. Like these companies are growing at 7, 8, 9% every single month.
I know it's huge, isn't it? It's hard for people to actually not only comprehend it, but believe it, that you can actually, particularly when you come from Australia, because we're in it's a very mature, old style economy, that we basically have here. So you get the boom and the bust cycle in terms of, the commodities, the iron ore, etc. But when you talk about companies like you invest in and probably like I invest in, and you look at the growth, it's like they almost go, we don't actually believe you, even though the numbers there. Do you know what I mean? There's so much happening.
I'll give this. There's one thing we do very differently to other investors, I think, and that's that we weight execution more than opinion. Like if a company's growing at 100% and I think the product won't work, we might still end up investing in it. Like if we can see the web traffic, we can see the revenue, we can see that the people in the industry that are allocating their wallet share, that are making those decisions, if they love it and they're going for it, that is far more important than my opinions as a generalist fund manager on what product's going to win in the sector. Yeah. The reason that's so different is if you ever speak to a fund manager or an analyst, they're always like making predictions and giving opinions. And I think this, what people misunderstand is that, and it's not this, it's everyone's got it the wrong way around. And what people don't understand is this aspect. And if you think about all those phrases are opinions, they're saying that they think something. But for me, it's like, okay, you like the stock. Okay, it's a great company and everyone likes it. And it's the next big thing. Okay, what's its growth rate? It's like, it's 10%. Well, it's clearly not changing the world. It's clearly not like sending a ripple through society. It's not moving the needle. And your base return, it's going to be pretty hard to do better than 10% long-term out of a company if that's its long-term growth.
Absolutely. You make a really good point on that, because it goes back to, of course, numbers can lie. Of course, you can get a situation where if somebody wants to commit fraud or whatever in the accounts, they can fiddle them. But basically, at the end of the day, the numbers aren't going to lie. And you're so right, because all of us as investors come with preconceived ideas, opinions, etc., etc. And I guess that's one of the problems for let's say, a new investor or somebody that's trying to understand, like when I invest in a certain fund management company or whatever, how do you differentiate between something like you, where you're basically saying the numbers don't lie, they will tell you the story, forget all this other noise around there? And I think that's kind of a positive and a negative. And the positive, I was listening to one of your podcasts, or one of your YouTubes, and you made a really good point about, because I think you mentioned when we were chatting before, you worked in private equity. So you get the fact that stock markets can create these incredible opportunities for investors, where we get those big sell-offs like we did, March a year ago, but also recently you've had another big tech sell-off after the spike. And as you say, in a private sense, you would not see somebody flogging off their company willy-nilly just because you've got a big liquidity drawdown event. So when you go to analyze your companies, I think you're always saying, well, the growth is still there, therefore it's the valuation, it's the price out of the earnings or sales that's been completely warped. And is that a good buy signal for you?
Yeah, definitely. I mean, you do need to run the numbers on these companies, because something trading at 5 times sales and 100 times sales with similar margins are just going to have very different return profiles over the long. And there are companies, almost of similar quality, like with that level of disparity in the market at the moment. Look, I think the opportunities come at moments. We're actually kind of in one now. So all of our companies accelerated and growth stocks sold off 20 to 25%, and to the lows, 4 weeks ago, even more. So in those situations, we're super simple. Our process is super simple. We'll just look at the fundamentals, look at the latest results, look at the web traffic. An important note is we don't just take things from the company. We do take them from alternative data sources.
Right.
Because we're mostly in tech, we can do that, because there's generally an internet angle or web traffic angle. And if the company's still executing, you just hold it. You just don't sell it. Whether it's gone up, down, or sideways should largely be irrelevant. There's maybe an exception if things quadruple, in a month or 2 months, which has certainly happened to us a few times. Sometimes then we'll take a bit off. But usually we regret it. Usually it's gone up like that because they've just exploded in growth, or the thesis has just proven itself out, or they've flipped into profitability, or something's happened. So it's 4 times more expensive, but it's a significantly better company. Maybe not 4 times, but maybe, it's been completely de-risked. So, that those returns will come in the future. But I think the one guide stone you have is fundamentals and the company executing. And I'd say, depending on, I think retail investors have a really good advantage here. So, retail investors can avoid the noise. Generally, they were buyers in March. Generally, it's institutions that were short these tech stocks. It's institutions that underperform the market. And it kind of implies that retail investors and insiders are the ones that outperform. So you can do really well. I think the guide stones that people should be using are things like just the company's key KPIs, like its users, the revenue per user, its revenues. Don't get lost in the weeds of valuation and earnings. You need to go to fundamental economics. But the company, all things equal, if a company's twice the size, that's probably going to do good things to the share price. And I think that's an important, thing to note. You really can do well in the market by focusing on companies that that are really, really doing exciting things, that are constantly hitting their targets, or exceeding them.
I guess the only thing is, I agree with you totally, and actually write about this in the second book, because Morgan Stanley's done some quite interesting work on, at the end of the day, you want to invest in a company that is materially growing, because it is going to be worth more in the future. You're not relying on an external, cyclical, cycle to impact on the earnings. But I guess if you look at, because I also noted that you're probably in the May summary of your performance, you were saying you're underweight SaaS companies, maybe the valuations are still too stretched. So I guess one of the concerns probably some people is they kind of jump on, let's say, to a software company, and the multiple is just way, way too high, and you're discounting too many years in the future. And obviously there's big scope for, if the earnings disappoint and they don't deliver, or just basically you've just bought it and it's too expensive. So are you a little bit more disciplined about you want that 100%, let's say, revenue growth or whatever.
Mm.
But do you have cutoffs of when you say like a price to sales or an enterprise value to sales, of when you will say, no, 20 times is just too much, we're not going there?
So I think rules like that are kind of unhelpful, because it's the exception to that rule that will be the best performing stock in the industry, like almost certainly.
Mm.
And if you're systematically missing the outliers in this game, you're probably gonna, you are going to underperform. I can almost guarantee. It's just how the numbers work. You have to be in the best performing stocks. Look, we do have a process. We do it the same way every time. We don't look for a particular price to sales ratio or anything else. We basically need to hit 4 times over 5 years. The reason for that is we charge fees and we make mistakes. So we need to at least give investors, we aim to get over 3 times in 5 years.
Right.
And the aim is actually to do 10 times in 10 years, which is 3 times 3. It's close enough. So to do that, we'll model things out and we'll assume growth slows down dramatically. We'll assume the valuation multiple compresses, probably at least halves. And then we'll look and go, okay, does that, and we'll compare that to like long-term averages. And we'll see if it can still get that 3, 4, 5 times return over 5 years. If it's yes, and it ticks all of our boxes and it's got customer love and the web traffics are going through the roof and everyone's talking about it and you can tell that like there's something special going on, then we'll almost certainly buy it. We will buy it. I think it's weird when you see other fund managers, they'll be like, it's 25% undervalued. And it's like, well, have you ranked every stock in the market and you invested in the ones that are most undervalued? Or have you just randomly woken up today and decided that this one is minus 25 and you're going to buy it? I know. We actually stick to our process. Like, if it ticks the boxes, we want to own it. We'll obviously see how adding that company changes our portfolio characteristics. So now it's pretty hard to add things. Like if the portfolio is growing at 150% and it is still well off its highs, we almost need something to be doing better than that to think about adding it. Or we're just kind of, we're actually just reducing the quality of the portfolio. But yeah, we do that systematically. I think EV sales, you can't, it's very hard to use guidelines because, Afterpay was 60 times sales 4 years ago, and that became the best performing company. And so people in the market missed that, even though they could see the execution the entire way. You didn't have, like, who knows why people like Afterpay? I've got my theories, I've got my opinions. But who knows if there's some weird millennial shift away from credit cards, or the name just hits a resonant frequency in people's minds and they click it. Who knows? But one thing you do know is that people did that. And they went from zero to a few hundred thousand customers, 1 million, 2 million, 5 million, 10 million. Like that's the profile we want. That's the profile we look for. And there's no reason other people can't find these kinds of profiles and invest in them as well. The hard rules. Yeah, actually, I think to be honest, I will actually clarify. There are some tricks to growth investing. It's not super easy. You have to actually do the work to get them right, differentiate them. I think somebody could find a company like that and do very well out of it. But you can't do compound growth rates in your head. You can't do multiple contractions and 5 years at 80% growth that slowly fades down to 30%, and the multiple contracts from 18 to 9. You can't really do that return in your head. You have to run them out. You do get a bit of a feel for it, but you still have to run the numbers, I think, to really get good at growth investing.
Yeah, well, that's fair enough. Is your pond, so to speak, where you do most of your stock selection, is it over in the US, or have you got a much wider remit? And if you do, how on earth do you sift through so many different companies?
I'd say we have found quite a few companies in Australia, but it's mostly in the US, and then the leading growth companies in Asia. If you screen for companies over $1 billion in those developed markets, $1 billion market cap in those developed markets, almost all listed on Australian, UK or US exchanges, then you look for companies growing over 75% that are sensible in technology and life sciences. You really narrow it down. Each one of those, you're probably talking about 400 or 500 companies, but there are several hundred companies that are growing at exceptional rates, doing interesting things. And then we've probably got, I guess 45 of them in the portfolio now. Right. I've never felt that we've been short of opportunity. I think At the moment, there's more growth companies than ever. A lot of them are IPOing or SPACing in the US, probably less SPACs now, more IPOs after the bust. But there's a lot of growth companies. Often at the IPOs are too overhyped and those companies have been too expensive generally, with a handful of exceptions. But there's new companies coming to market all the time. And I think in this world, you can build a $10 billion globally significant tech business in 6 or 7 years.
It's amazing, isn't it?
Yeah. So you're talking about companies that were founded in 2016, 2015. It wasn't that long ago. And actually, instead of setting up funds, I'd encourage any young people to do that.
Exactly.
Much more money, much more meaningful. Don't throw your hat into this ring. It's not what it looks like.
Yeah, no, I agree. And that's sort of is that whole concept of weightless companies. That's kind of what Victor Schvetz from Macquarie, the strategist there, he talks about weightless companies.
Weightless, what does he mean by that?
Basically, you're not talking hard assets. Okay, Tesla is the difference to the rule because they're building, rolling out gigafactories. And obviously Amazon has built out these huge warehouses, etc. But you could argue a company like Netflix or a software company, they're weightless. So it means that their capital is more in intellectual property. It's people and producing those services as opposed to producing manufactured goods. And he's very much an advocate that the economy generally on a big holistic approach has moved more and more in that direction and will increasingly with machine learning and AI, etc. We are moving to what he calls, software, weightless companies, robotics, AI, data analytics, all these things that, once upon a time we used to pay up for, buying a television. Now television is pretty damn cheap compared to other things by way of example. So that's just the thesis that he puts forward, how our economies are changing. And it's one of the reasons why there's been like a lot of noise about this whole thing about is 1970s inflation coming back, and we've got, the sharpest economic recovery since World War II, and everybody's been buying those so-called value cyclical stocks, etc. I mean, is all that for you kind of just noise that you just completely ignore? Because at the end of the day, the companies that you're picking are going to have that growth profile and they're going to see through whatever inflation that we have. Are they able to pass on that inflation if it does come through? Or do you kind of do any hedging? Because I don't know, it's been such a big thematic that's been causing so much debate.
Yeah, look, I think by far the dominant factor in all this is how the companies perform.
Yeah.
So if you've got a company that in 2 years goes from 1 million at the start, then 2 million the next year, and 4 million the year after. So over 2 years, it's quadrupled in size. We have many examples of companies that have done better than that we've owned. That's going to trump whether they're 20 or 30% overvalued, whether inflation causes a little sell-off. It's irrelevant whether interest rates are 1, 2, 3, 4, 5%.
Yeah.
That's by far, for us, the first point is getting that right is by far the most important thing. The second thing is look at inflation, right? So inflation will affect interest rates, which affect multiples, and the multiples will compress in advance of any prospect of interest rates rising. A lot of that's already happened. So multiples have roughly halved from the beginning of the year to the end of this one using forecast revenues. So that's a pretty big move, like down half. You saw there's a pretty inflation beat expectations. Inflation was higher than expected. And growth stocks rallied and rates went down. That shows you how far the positioning has come. So now the consensus in the crowded trade is the opposite. And growth stocks are now looking better than they've ever looked. To the extent we think about those things, it's like, okay, this is like, what are you waiting for? Like the stars are aligning again. The third thing is like, go to the fundamentals. What does inflation really mean to the fundamentals of each of these companies? So if we got a lot of e-commerce platforms, and a lot of them have very exceptional pricing power, and in things like luxury goods or essentials, they'll easily be able to raise prices. So if prices are rising by 5%, firstly, for something like Amazon, that's probably just going to translate directly into another 5% top line growth. For most of our companies, they'll actually do a lot better than that and have been able to lift their prices way above inflation over the last year. And so they'll do better there. But then what about the input costs? So I guess that's coming back to this weightless concept. These companies don't really have inputs. It's tech. They're not taking in iron ore and pumping out steel rings or whatever it is that people make out of iron.
Yeah. Yeah.
They're not. The worst place to be would be like a leveraged manufacturer in the middle of the supply chain, because you don't know where the inflation is going to come. If it comes from your inputs, you have to pay higher prices. Your interest rate's going to be higher. You could get wiped out, and that's actually what happens in those situations. And then obviously everything rebalances. There's less people doing that, so their prices rise and it just flows through. Causes huge amounts of disruption, huge amounts of bankruptcies, but all kind of evens out. Like, our companies don't do that. They don't have these crazy input costs. And to the ones that do, like maybe we've got a little bit of Tesla still, those their prices will be fine. The other aspect, I guess, is wages, and that's a weird one, because the most important asset in all these companies is their staff. But they're good staff. They mostly pay in stock, and they're actually very human capital efficient. So they don't have lots of workers. It's not like you've got a factory with 1,000 workers and inflation's 5% and unions are insisting on an 8% wage increase, which is fine, but it's just not good for the equity holders of the company in that situation. Like, again, our companies are just not in that situation. So to the extent you look at that, like pull that all apart, it's like, well, valuation multiples have already compressed in anticipation of this. Interest rates are obviously irrelevant to our companies. They almost all have net cash.
Yes.
Rising inputs are irrelevant. They're going to be able to raise prices probably more, and they're extremely human capital efficient. So all of that's it's a
pretty sweet spot.
And then if you think about it, like, that's what's happened. Like I said, our growth, our company's accelerated from 100% average to 150%. And we probably added more to the faster growing ones, but they all accelerate. And another thing I'd say, what happened, it's now clear what has happened. So everyone was worried. There's a huge consumer boom in coronavirus, and all the e-commerce stocks went ballistic. That then evolved into a broader consumer boom. So the e-commerce providers stopped accelerating, obviously, a year later, but maintained their sales. But then that consumer boom spread out into other places. The two most obvious ones are houses and real estate. So housing prices went ballistic, and autos. And auto prices, I've never seen anything. I haven't even read or heard of, even in the old investing books, of secondhand car prices going up like the way they do in the United States.
I know, it's crazy.
Buy a car and sell it for more. Like, that is just, it's just the wrong way around. But that shows you the extent of the consumer boom. And then again, think about what that means for us. It's extraordinarily positive, for our companies. So we're pretty, I don't want to say blasé about inflation, because every time rates rise, you can expect a 20% knock off our multiples, which translates, if it happens in one day, that's a 20% drop that day. If it happens in a month, 20% that month. But the good thing about multiples, they can only compress once. And then you get the fundamental growth. And then in a future environment, multiples might inflate again.
Exactly. And I guess, people just get very bogged down in, as you say, that whole concept of whether it's relatively cheap or whatever. Just couple of things. Maybe give people an idea if you've got like 45 stocks in the portfolio. So how much of a percentage weighting at your upper end will you move to before you go, woo, that's just getting all a bit too much?
Yeah, the biggest is a bit over 7. Most of them are kind of the 2, 3, 4% range. Look, in tech investing, it's extremely fashionable to be ultra concentrated. I've seen so many funds blow up over the last 5 years doing this. Like, they just don't. Or certainly drop 50% and do nobody any favors. Like, there wasn't one software company that went up 20 times. There was probably 20. There wasn't, there wasn't one good e-commerce company that has done 20 times. There was many all around the world. I think if you're actually good at what you can do, you can easily find the opportunities to find more. I think that applies to people investing on their own, but you hear, like, there's a fund manager here that talks about, you only get one good idea every 2 to 3 years. It's like, what? That's crazy. We've had so many companies that have gone up, more than 5 times in the last year. And for good reason. We were pretty early on in zero, but we made a mistake. I've learned this the hard way. All I had to do was ask one question. Sorry?
You sold too soon?
We did, yeah. I'll go into, we sold because growth slowed down, but then the multiple doubled. So I think we sold like mid-90s, and then it went up to 150, 160, and now it's 120. So we did something similar with Apple, actually, back when we used to own that company. We sold it. It was like, smartphones saturated. They're not going to grow. Smartphones were flat for 3 years. We got that completely right. And then the multiple doubled and the stock doubled. Sometimes everyone's like, oh, when the growth slows down, your stock's going to get smashed. It's like, actually, when the growth slows down, they usually flip into profitability and then the multiples double. That's been my experience anyway.
Yeah.
It just shows how what people say and what people think. And these are smart people that are very experienced, like much more experienced than I am, that often get these things the wrong way around. Anyway, Zero, what are we talking about? Oh yeah. The one question I should have asked was, are there any other companies like this in the world that have led me to Shopify at like $20? And, you know, just right at the beginning of the software rip, I've been all over it and had 10 of those companies. But it didn't. I was just like, oh, I was still probably drinking some of that concentrated Kool-Aid. It's like, let's just found a good company. Let's load up. It's like, no. If you do it properly, do it right. If you understand why that's a good company, you should be able to apply those principles more broadly. It's much more complicated. It's much more difficult. It's much more work, but it's so worth it because, you know, we had our companies are really volatile, but our fund is so much less volatile than it ever was. And a number of our companies could go bankrupt tomorrow. Not that any of them are anywhere near that. We don't do turnarounds. We don't do stress situations. But we're really not beholden to any single performing company or sector because we've got those 45.
And I think that's such a really good point, because people are always, as you say, look, you know, you find one good company every year or something, which I totally am with you. I disagree, particularly when you go fishing in the United States. I mean, you're just almost spoilt for choice. I think I said to my fiance the other day, I said, this is really frustrating. I don't want to sell anything I have, but I actually want to buy some more stocks. So it's that thing of, you know, you don't want to get too many. But I think people get really impatient and they just want to say, well, you buy an Afterpay or a Zip, or, you know, you ride the Tesla when it went up to, you know, post split up to almost $1,000. But if you can find those amazing companies that can keep on growing, and the point is that probably like Apple, it's not always that line. They will flatline for a while, but the really good ones can kick it up again. And I think that's, although you're not investing in those big FANG stocks, and I totally get the reason why. I mean, for somebody out there that just kind of wants to sleep well at night and pop some away in the back pocket, they're probably going to do reasonably well out of those stocks because they just have an inherent ability to just keep on recreating themselves and, you know, creating another wing. Just briefly,
on that point, I'd say if you, I don't sell those things. I think that's the mistake.
Yeah, exactly. Don't sell.
But don't necessarily put 25% of your money in one stock.
Exactly.
The best risk reward is probably around 4 or 5% maybe, or 3, 4, 5. Like if it harms, you lose 2%. If it really rips, you can double your entire portfolio.
I know.
If you get something like an Afterpay. Like that's the best risk reward. You're taking very, very, very little risk, almost meaningless risk across your whole portfolio.
Yeah.
But you can really move the needle on your wealth.
Yeah.
That.
So I guess probably one of your biggest mistakes then is selling too early with some stocks. Are there any other little errors, or when the models have kind of fallen over and you've gone, well, that one didn't work out?
Yeah, there's errors. I guess, what are the errors? I've learned that we can get really good data sitting here in Sydney. We can see web traffic, we can analyze stuff. There's many advantages of doing what we do from here. The disadvantage is we're not on top of, like, you know, supply chains, B2B, business to business.
Yeah.
They're complicated. Like I bought a tech stock that used to make vibrators and speakers for phones in Hong Kong, going ballistic. Number one, you know, huge margins, some of the best numbers you're going to see, you know, hyper growth, but like super profitable, everything just working amazingly well. And then all the like Apple, Samsung, somebody else got together and just launched a new competitor.
Oh,
so it's like, we cannot have one company just dominating this one part of our phones. We're all going to support somebody else and guarantee them 20, 30% market share or whatever it was. And that was like, there must have been like 20,000 people in Asia that knew about that. Certainly a few hundred, you know, but I did not, you know, I was the last to know in Australia. So we stay really far away from B2B now. What are other mistakes? The mistake you make in growth, there's a whole set of tools for value investing and a whole set of tools for growth investing, completely different. You cannot use a value mindset to growth ones, or you're going to firstly think all the good ones are sells. Yeah. Secondly, you'll get the whole order wrong way around. You won't find the good ones. You'll be investing in the worst software company, not the best.
Yeah.
But there is a different set of tools that you have to use. You're talking about return on capital. You're talking about return on investment spend. You know, return on salaries. what can an engineer do? What can a sales team do? And how much are they generating? And we pay really close attention to that, because there are companies that will grow at 90% or 100% plus. They're still somehow destroying value.
Yes.
Maybe they've gone from 200 million to 400 mil.
Yeah.
They're now spending $700 million.
Mm.
And so if you're spending 700 to generate 400 mil of revenue that year,
the maths doesn't work.
Yeah, correct. And I've also found another thing we've also found that is just, it's hard for me to think of a counterexample to this, is that when these software, when these companies go through these investment cycles where they're like, revenue's coming in, okay, we'll spend it all, we'll grow again, revenue coming in, we'll spend it all. And all the value investors are like, oh, you're losing money, it's crap. And then it like does 20 or 30 times. That's great. But the ones that push it too far and spend more than the revenue they come in, so they actually have a cash draw every year.
Yep.
They're the ones that can compress from 20 times sales to 2 times sales.
Yeah.
They're the ones that you can really get hurt on. Because the ones that pay stock and generate cash, like they just float around. There's nothing that can ever kill them. They're so robust. And as they prove out their model, as they add customers that are effectively locked in or have very high switching costs, they just continually create value every day. But the ones that are kind of burning cash every day and like, okay, let's borrow some money to do that, that's when you get like some pretty serious risks coming in.
Yeah.
I think that's one of the examples of mistakes that you can easily make.
Well, they get
things, but we're pretty good.
They get swept up, don't they? Like kind of in that whole bubble that we kind of saw with the SPAC mania and everything
February
like that.
Wild,
You saw it. You saw it sort of start at the top. It's typical bull market features where it kind of starts at the top. The money comes into the big ones, and it keeps filtering down and down and down. And you're absolutely right. At the end of the day, when I was an analyst back in the dark old dinosaur era, at the end of the day, it's always about cash flow. And there's nothing wrong with a company having debt as long as they've got the cash flow in the worst case scenario to cover those interest payments, etc. But a business cannot go on indefinitely spending more than it's making. And I guess this is kind of where the value investors come in and they get really gnarly and they say, well, the only reason why growth is doing so well is because interest rates are at record lows and it's been so easy to borrow money. And of course, there's a whole lot of zombie companies out there wandering around that shouldn't exist, but they're not allowed to go bust. And ironically, they're not necessarily in the tech sector. They're in the old economy stocks. But a company at the end of the day has to transform itself into an Apple or an Amazon, or even probably where a Tesla is going, where they throw off this ridiculous amount of cash that they can self-fund their expansion. And as you say, if they want to, they can play a dividend or they can, do stock buybacks. And obviously you can debate whether that's ethical or whatever. But that's the backstop for investors when the crap hits the fan. That these companies are still sitting on huge amounts of cash that may come back to you as a shareholder. You don't want companies that are cash flow negative all the time. They have to evolve. That's kind of how I see it. Okay, I've taken so much of your time, Michael, and it's such a fun chat, and I'm sure we could keep on going forever and a day. Is there any stock you want to touch on briefly, or, you're so generous.
When people ask me this stuff, because I usually just say the most interesting thing I've worked on in the last week, but then it's not necessarily the thing that we have the most conviction in. Look, I still really like the e-commerce platforms here, Mercado Libre and C. They're so dominant in their respective regions. The C is starting to attack Mercado Libre in South America, bizarrely.
Oh, interesting.
And I wonder why C's outperformed so much, because C, unlike Mercado Libre, C's got an extremely profitable gaming business that it can use to fund its expansion. We really like the kind of Asian brokers, so Futu and Tiger. Their companies, I think Futu did 350% revenue growth, Tiger did 250. They're right at the beginning of their journey. They've only got a few 100,000 customers, plenty of room to grow. In the life sciences, we've done a lot of work on some Alzheimer's treatments that have got really promising early data. And the FDA has just approved a treatment for Biogen, which we think is madness, but does set a precedent for approving drugs for diseases with no treatment, effective treatment, kind of in the hope that would work, which is strange, but you play the game as it comes, not where you want to be. I'm not sure, I probably butchered that phrase there. But if that's a playing field, then companies with like some kind of efficacy data should do really well.
Yeah.
We obviously own Moderna. There's two other companies we really like, Alnylam and Ultragenics. And so Alnylam kind of both target the liver. So Alnylam has a platform where they can basically silence protein expression in the liver and cure a bunch of diseases that way. They've already got 4 approved treatments. Ultragenics has a viral vector that can actually put in genes to create proteins to cure disease in a different way. If you think about the liver, you've got 2 companies that both growing at 100% plus with multiple existing clinical assets.
I just lost you.
Can you hear me now?
Yes, but I can't see you. Maybe it's my end. Michael, hello. Oh, there you are. You're back again.
Anyway, as I was saying, yeah, so these companies, one of them can silence particular protein expression. The other one can use viral vectors to effectively create it. And both of them can now roll that out after disease, after disease, after disease. So along with Moderna, that's now 3 like phenomenal platforms we've now got in that space. And they're kind of 5-10 year plays. Like they're super excited just to see what they can do.
Yeah.
So there's some ideas we're looking at now.
Fantastic. So if people would like to invest in your fund, how do they do that?
It's probably best to go to our website, www.fraziscapitalpartners.com, or reach out to me on Twitter or email. We're open to wholesale investors now. We will do a retail fund later this year.
Oh, that's exciting. So essentially it's wholesale investors at this stage?
At the moment it's wholesale investors, but the idea is we'll just set up a simple feeder fund. We probably won't market it actively or really do much, but if people do want to invest, there will be a way, hopefully in the next couple of months.
Oh, that's exciting. And you're not being tempted to go down the active ETF route like so many people are in the US?
Looked at it. I think if anything, you'd go the listed investment company route, which is kind of more manager friendly, less investor friendly. But having permanent capital is just an advantage. From a manager's perspective, the managed ETFs, you can still get redemptions that day, right? And then have to sell a bunch of stocks the next day. So it doesn't really give you any visibility. It's very hard to buy when everybody's panicking and markets are moving around 5% a day.
Yeah, I get
it's very hard to do that when you know that, you could be a mass force seller the next day.
Yeah.
So if we did a listed structure, we'd probably either list the management company or list the trust or one of the trusts.
Yeah, that makes sense. I get that. But also too, thank you for your time. Big congratulations. Excellent performance. And you're very generous with, investors with the information that you give out. And I think that's something that's really amazing and something that's changed over time, because normally fund managers were like, they don't say anything.
If you get something wrong on the internet, people let you know immediately. So you've got this like immediate feedback loop. Like I press send on an email, send it out to the subscribers. I will know within 20 seconds if there's a typo.
Oh dear. Well, did I tell you? Did I tell you Kathy Wood is IE, not Y? I'm the worst speller in the world. And for a writer, that's really embarrassing. And I was reading one of your emails and I go, did what I did, Kathy, IE.
Oh, really? Good to know. Yeah. What was the one I did a week ago? I did PSS instead of PPS at the end.
Oh, that's because you're just too young. You didn't write letters by hand like we all did, or you forgot to do Latin at school. Anyway, thank you so much, Michael, for your time. I really appreciate it. And it was lots of fun. And hopefully everybody has got a lot out of it.
Yeah, really appreciate it. Thanks so much.
Pleasure.